Okay. Um, Let me wait um, couple of minutes for the people. I'm recording this session and I will, I will, let me, let me wait. I think you can hear me and let's see. Okay. I will wait a couple of minutes. Okay. Shelby, can you hear me? Okay. I think you can hear me and the time I think I need to start. Let's start chapter 10. Okay, today's section I will cover chapter 10 and chapter 11. Also, I will cover the exam questions and we will solve the exam questions, exam 2 questions. Shelby, can you hear me? I hope you can hear me. Okay, yes, okay, good. Okay, let's start. Okay. Okay, chapter 10 is the features of stocks, and in the for this chapter, the agenda is a common stock. We will learn common stock, dividends, stock splits, dividend reinvestment plans, repurchase of stocks, and valuation of using dividends. You already watched the video staging videos, but this session is only quickly cover the important points and solve the questions and review the exam 2 questions. As you may remember, this is the finance diamond. We have indirect and direct transfers. We have financial institutions, savers and borrowers, and financial markets. We already look at the toolbox, present value, future value formulas, perpetuity, annuity, return formulas, and risk management. And now we need to learn the valuation of the stocks using the financial statements and try to find the value of the stocks. And let me go briefly what the meaning of the common stock. The common stock is it shows the ownership in a company, and firms are financed with either debt or equity or both. And equity is the ownership in a corporation, is the residual claim, and it's riskier than the debt from investor perspective. And the debt is another component of the financial the balance sheet, financial situation, and the debts includes loans and bonds, and covered in chapter 12. Okay, common stock is, we can divide the common stocks in preferred stocks and common stocks. And preferred stock is the enables preference and mandatory payments, and it is a preferred or superior position. Common stock represents a final claim on the firm's assets and earnings after the firm has met its obligations, creditors, and preferred stockholders. All firms issue common stocks. And so there's an agency problem because owners and managers usually not the same person. But for the small firms, the owners, let's think about it this way: you own a startup and you own the company and you manage the company. But for the bigger firms like Apple, Amazon, or other bigger and mid-sized firms, the owners, the shareholders, and the managers are not the same. So that results agency problem. And so management is the agent of the owners. Who are the owners of the company? Owners are the shareholders, the stockholders of the company. So the agency problem is a potential conflict of interest, and manager's interest is usually divided from the shareholders' interest. For example, management wants higher salaries, right? The CFO, CEO, or CTO always wants to higher salaries, but the owners, the shareholders of the company, doesn't want to pay much. And this situation results the agency problem. So how can we solve this, the agency problem? They have to reduce the potential conflict of interest or agency problem between agent the manager, the management, and the owner of the company. By linking the welfare of the management and the owners together, how can we do that? We can give management stock options and develop a reward system based on performance of the management. It includes stock options in management compensation or employee payment. So, and the second way is develop a structure in which the chain of responsibility starts with the owners and the flow of the employees. But you can just interrupt me anytime you have question, and I can cover some areas more more broadly, or I can I can go deep if you like to ask me questions. So I just quickly review all the chapter, and we'll solve the exam questions. So we will, if you look at the stockholders and management, you have a body in the middle of stockholders and management, which is board of directors. Board of directors selected by stockholders, and those guys responsible to the stockholders. And also these board select management, CFO, CEO, or a CTO, and the management responsible for the board of directors. This is the middle body. And the rights of the common shareholders is the voting authority to elect a board of directors, and cumulative voting helps minority to gain representation in the board of directors. Okay, so common stock provide preemptive rights and rights offerings. What is preemptive rights? Preemptive rights is shareholders have the right to maintain their proportionate ownership of the firm, and usually costly. So some firms have changed their bylaws to eliminate preemptive rights. You may remember if you watched the Social Network movie 2010, and in some part of the movie, a guy, the partner, comes from the company and asking his ownership, and the movie asserts that Mark Zuckerberg eliminates some portion of the basically they don't have preemptive rights, and the ownership of this guy goes to zero, but he doesn't know it. So the preemptive rights is extremely important in order to maintain the proportionate ownership of the firm. The guy has the 50% of the company, or the 40% of the company, but somehow they changed the ownership type, the ownership ratio, and his ownership goes to zero because probably they don't have the preemptive rights. And the right offering is the sale of the new securities to stockholders by offering the option, in other words, rights to purchase the new shares. And dividends, dividends is a distribution from the earnings of the company, and it regular quarterly dividends. Some companies pay dividends quarterly. Some others doesn't want to pay. It's not mandatory payment. This is the decision of the company. They may want it. They may want to pay the dividends, or other companies they don't want to pay dividends. There could be different reasons why they choose why they choose the one than the other. And the extra dividends and irregular they can pay extra dividends and irregular dividends, and the dividends can be paid in cash, or the dividends can be paid in stocks. And what is payout ratio? Payout ratio is very popular in stock market. And if you're investing in the stock market, you're probably looking at the payout ratio for each company. This is the dividends or earnings per share. What is earnings per share? Earnings per share is the earnings, the net income divided by number of shares that the company has. So first you need to find earnings per share, and then by using earnings per share on the denominator part, you use dividends per share, and you find the payout ratio. Okay, let's go next. So that's important because it can be a little bit confusing with the dividend payments. So do investors care about firms' choice of paying a dividend and retain earnings? Yes, And does the frequency and amount of cash dividend tell investors something about a firm's earning ability? Yes, exactly. Timeline of the paying a cash dividend. So this timeline is the declaration of the dividend, the ex-dividend date, and the date of record of the dividends and distribution date. These are the all different dates for the dividends. And if you own the data before date of record, let's say August 1st, the company will distribute the dividends. So yeah, it's important to know the dates and what's the meaning of these dates. And you already has this question or similar question in your exam too, and the dividends can be paid in stock. And we have a question for these tables. I will skip the slide and I will explain in the question. So price adjusts for stock dividend. Price adjusts for a stock dividend. Why? If you own 100 shares before the stock dividends with a price of 20 per share, then 10% stock dividends cause 20% stock price to fall 18.18. And yeah, so this is yeah. So if you own 100 shares before stock dividend with a price of 20 per share, then 10% stock dividend causes 20% price to fall 18.18 because basically company issue new stocks, and this cause stock dilution. Okay. Stock splits. Shareholders may prefer low-priced shares. A 2-for-1 stock splits does not. Okay. It could be 2-for-1, 3-for-1, or 5-for-1. The company decides the split amount, but it doesn't affect the firm's assets and liabilities. It causes downward price adjustment, causes $80 stock price to decline. Let's say if we have 2-for-1 stock split, and the value of the company is same, but the company decided to issue new stocks. They have, let's say, they decided to split the stocks. So basically, if they have a split to 2-for-1, the value of the stock declined from 80 per share to 40 per share because of the split is 2-for-1. Let's say if the stock price is 27, what will be the price be after 3-for-1 splits? I solved this question in other recordings. I skipped. And dividend retirement plans that permit stockholders to have cash dividends reinvestment in additional shares instead of received cash. Yes, and additional cash contributions may be allowed. Skip this. It's obvious. And repurchase of stocks. So companies can buy their own stocks if they think the stock value is so low for their company. So Securities Exchange Commission allow the companies to buy the stocks, their own stocks, but they need to follow some regulations and some programs, buyback programs. They need to publish their buyback programs before they buy their stocks. So corporations with cash may reduce the number of exit shares because they're buying their own shares. Let's say if they have 1 million shares outstanding, they decided to buy some of the outstanding shares, and the number of exiting shares will decline based on the buyback programs. The decrease in outstanding shares may increase earnings per share because the number of outstanding shares is decreased. Even if the earnings are same, the number of shares are decreased. And the decrease in outstanding shares may increase the price of stock. Okay. Okay, let's go. Okay, valuation of stocks. The value of an asset, present value of future cash flow. This is important because you always take into account future cash flows, not the past cash flow. The past cash flows. You are estimating the future cash flows, and you're discounting the cash flows for today. So stocks with constant dividends, if the company paying constant dividend, the calculation is very easy. It's exactly the perpetuity. You have dividend payments divided by return on equity, and you find the price of the stock at time zero. So stocks with growth in dividend, if they're paying, if they're not paying constant dividends, but they pay they're paying dividends in a growth model, and you need to take care of this growth, and dividend payments divided by return on equity minus the growth rate. So simple calculation. I think logic is simple. And so I put the Tesla stock values here, and from the, I guess, Yahoo Finance. And you see, if you go to Yahoo Finance or other websites that shows the stock prices, you will probably see the open price, bid price, ask price, day range, 52-week range, the volume of the stock for that day. Let's say, I think this is the end of day price for the May 22 Tesla. Now Tesla is, I think, around $1,000 per share. And yeah, a bunch of information regarding the data. It's some of them for the technical analysis. Some of them is fundamental. Fundamental meaning the financial statements, cash flows, and you see, let's say, earnings per share. This is fundamental of this company. It says a trailing 12-month earnings per share is negative 0.81. Even they have negative earnings. The Tesla stock price is soaring up, and yeah. Anyway, yeah, you can just investigate all the values and all the. I recommend just go and look at the company statistics, historical data, financials. Get used to and familiar yourself what data it's available for each company and for the stock market. It's fun, I guess. Okay, let's solve it from one. And Consolidated Edison Incorporation is a regulated utility company that serves the New York City area. Suppose Constellation plans to pay $2.3 per share in dividends in coming year. If its equity cost of capital is 7, the R_E is 7%, and the dividends are expected to grow 2%. The G is 2% basically per year in the future. Estimate the value of con. So we know the calculation, right? We know the formula of this question. So just remember, what was that? We have dividend payments. We have return on equity, or the question says the equity cost of capital. So equity cost of capital is R_E minus the growth rate. So all the data is given. So we know the dividend per share, we have cost of capital, and we have growth rate. So the price of this stock should be 46 based on this calculation. So we're done for chapter 10. And I will quickly go to chapter 11. Let's close this and go to chapter 11. Let's start quickly. Chapter 11 talks about stock valuation. I skipped this. We already know what is the payout ratio. This is kind of a quick review for the chapter 10. And the valuation using dividends with constant growth. As you see, we have constant growth, per share stock prices increasing, and this is the dividend payments. This is constant growth, and this is the exponential growth for the dividends. How this exponential growth of dividend affect the price of the stock? We know the calculation. We have the dividend payment for the future, dividend payment for future, and we have the cost of capital. We have growth rate. So we find the value of the company should be $26.5 right now. This is the time zero, as you see. So we just using some calculation and find the value of the stock for time zero. I think it's important to understand. Same calculation. if the question gives you dividend payment times 0, you have to find dividend payment for the next year by using the growth rate. As you may remember, we already, for the prior question I solved for chapter 10, the dividend payment was time 1. But now I show you, if a company or if someone asks you, hey, the dividend payment right now is this, but asking you what is the value of this company, what is the value of, not the company value of the stock, you need to use dividend payment right now times 0 and find the dividend payment 1 at time 1 by using the growth rate. And with the simple calculation, you're just 1 plus growth rate multiplied by the dividend payment at time 0 and over cost of equity minus the growth rate. So you find the stock value at time 0. And if you just manipulate this equation, and you can use this difference, you can put this difference left hand side, and put the price ratio under the here as a denominator, and you can find the cost of equity equals to the same, the numerator divided by P0 plus G. So yeah, I explained in detail in my lecture notes, lecture recordings, the calculation. But if you have questions, just ask me. This is a simple manipulation, and you see we find the cost of equity. Okay. Why we are doing this? Because the question can ask you, hey, the value, the price of the company, the stock price is $1. We have the dividend payment for next year is $1 per share, and the growth rate is 10%. What is the cost of equity? So it gives all the values here and asking cost of equity. Okay, and uneven dividend growth, it could be dividend payments, not the constant growth rate, but it could be some uneven growth rate. So then we fit the curve. Let's say in time 1, we are expecting growth rate is this, but the next year it's maybe close to maybe 25%, but the other year is less than 25%. So it's not uneven, but you just fit the curve and find growth rate and use the same formula. And you can use the same formula. Let's solve a question. Suppose Target Corporation recently paid a dividend. Recently means dividend payment at time 0, and paid 0.68 per share. If its equity cost of capital is 10% and dividends are expected to grow by 8.4% per year in the future, estimate the value of stock. Same calculation. It's given the dividend payment times 0 is given, which is 0.68, and then we have growth rate 8.4. You just put the 8.4% here and find the dividend payment 1 by using dividend payment times 0 is 0.68 multiplied by 1 plus growth rate. We find dividend payment for the next year, right? So we put this dividend payment for the next year as a numerator and divide by cost of equity minus growth rate. We find 46.07. Straightforward. Okay, so question 2. ABC Corporation just paid a yearly dividend of $1.25, and you expect dividends to grow by about 1% each year. Other firms with similar risk earn 9% per year. How much should you be willing to pay for a share of ABC? Same calculation, and we first needs to find the dividend payment at time 1. We know the dividend payment at time 0, so we find the dividend payment at time 1, and we try to find the price of the stock at time 0. We put all the values in this formula, and you will find the 15.78 per share. Okay, how many slides do we have? Okay, we in the middle of this presentation. Okay, and yeah, the evaluation using dividends with uneven growth. So what if we have uneven growth and dividend payments? So dividends may not be paid at a constant rate. no dividends, for example, we can see no dividends paid throughout the years, large initial dividends, declining growth in dividends, or stable rate. If you look at this table, in year one, the company doesn't pay any dividend. In year two, doesn't pay anything. Year three, just 10 cents per share, 20 cents per share, 35%, 35 cents per share, and it goes to year 10. And percent change in dividend. So yeah, what is the growth rate for year 4? If you look at the dividend payment paid in time 3, it's just 10 cents, and for time 4, it's paid 20 cents. What is the growth rate for the dividend from 10 cents to 20 cents? It's 100%. From 20 cents to 35 cents, it's 75%. You see, it's not stable. It's not even. It's uneven payments. So how can we deal with this problem? How can we find the P0 by using, if you have this kind of scenario? So simply you just find one by one. You just put the dividend payment here at time one, and discount dividend payment by using cost of equity. This is 1 plus cost of equity power of 1, which is 1.12, plus dividend payment at time 2 here, and over 1 plus cost of equity power of 2, because this is time 2, and time 3, time 4, time 5, and time 6, and time 7. So you find price of stock 0.92, but yeah, for time 7, but we want to know this is only the price take care of only from time 1 to time 7, but we need to take care of as an infinite number of payments. So we assume this company pays dividend as a constant rate after the 7th year, as you see, 10, 10, 10. So we assume this is the infinite, and we are using what is the value of stock at time 7 by using this constant rate, 10%. So we find at time 7, the value of the stock is 33. So we discount the value at time 7 to time 0. How can we do that? We know the value of the stock at time 7, 33. We discount the cash flow at time 0 by using the cost of equity rate, which is 12%, the power of 7. We find the present value of stock 14%, and simply we just sum two values, 0.92 and 14.92. If it confuses you, just go back to the lecture notes. I explain in detail the calculations by explaining more detailed. But simply you first calculate for the present value for 7 years, and then you see we have stable growth rates, and you just use the perpetuity formula and find the value of the stock for time 7, and then you you discount this cash flow for time 0, and you just sum up two values, and you find the value of the company at time 0, which is 15.84. Okay. Risk and stock valuation, how to get our discount rate cost of equity, R_E. The R_E is the required rate of return to induce investors to purchase a particular security. So it can be obtained by risk and return formula, as you may record from capitalist pricing model. So cost of return, or required rate of return, is equals RF, the risk-free rate, plus market return minus risk-free rate multiplied by beta of this stock. So security market line represents all the required returns associated with each level of market risk. And let's solve the problem, and you will understand what the concept is. Suppose a company pays $1.10 dividend that has risen at annual growth rate of 5.4. G is 5.4% indefinitely, and the stock has a beta of 0.8. Okay, if US Treasury bill of 6-month duration offered a risk-free rate of 3.5%, which is R_F is 3.5%, and the market return is 9.4%. So the question simply gives all the values for us, and simply we are using this formula. What is required rate of return? Required rate of return is equals risk-free rate plus the beta of this stock multiplied by the difference between market return and risk-free rate. So all is given. We know the risk-free rate, we know the beta, we know RM, we know RF, but the values, the RF is the US Treasury bill. This is the risk-free rate comes from, which is 3.5% plus the beta multiplied by the market return minus the risk-free rate. So we find required rate of return for this company is 8.3%. So we find this. In the previous problems, the questions already gave this value for us, but some questions just ask us the calculation of required rate of return. So we found it, and we put the value here, which is 8.3% minus the growth rate. What is the growth rate? 5.4%. So we have the dividend payment is given and growth rate is given. So we find V is the P0, P_0. We find the value of company is just shy of $40. If the current price is higher than 39.98, the stock is overvalued. This is just terminology in the stock market, and you find the value based on your asset pricing calculation. We call it the value of the company, the intrinsic value of the company. And then if the stock market has valued this stock, let's say 45 or 47, which is higher than the value that we find in our calculation, we just call it overvalued, vice versa, undervalued. Okay, multipliers. Another model to find the value of the company is multiplier models. And also we have some limitations for dividend discount models. What if a company doesn't pay any dividend? How can you value this company? Zero. Some companies paying dividends just zero. They are not paying anything. So you have zero dividend payments, the numerator is zero, and you have some values in the denominator. It doesn't matter, you find zero. The value of the company is zero. But it's not true. So we need different models to value the company, which is, one of them is multiplier models. Let's dive into it. And the dividends discount model values a stock based on the forecast of the future dividends, but a firm's future dividends carry a tremendous amount of uncertainty. Non-dividend paying stocks, as I said before, some companies doesn't pay any dividends. So how can we value the company? We can use a multiplier model. You can use a PE ratio, which is stock price over earnings per share. What was the earnings per share? Earnings, the net income divided by number of shares. You find, what does it mean? If you look at this formula, you just try to find earnings per share, because the denominator is the number of shares. You find earnings per share here. So you're using this value as a denominator, earnings per share, and the numerator is the stock price. You find price to earnings ratio, stock price to earnings ratio. Example, if the earnings per share is 2.45 and the appropriate PE ratio is 13, what is the value? So we already know the stock price P is earnings per share multiplied by PE ratio. So because this is, you see the earnings per ratio, if you multiply these two values, you will see earnings per share is equals to E, earnings per share, and they just disappeared, and you will only see the price of the company. What if you know, this PE ratio? It may come from the industry average PE ratio, or a tech company located in United States has the average PE ratio. You can just find this PE ratio based on the comparing other companies. And let's say you already know the Amazon, Alphabet company, the Google, or other tech companies, the Facebook, those companies' PE ratio. But you want to know some company, some tech company doesn't pay any dividends, based on the industry average PE ratio. You can just put the PE ratio here and earnings per share of the company, and you just find the stock value of this company. Simple. So in this case, the PE ratio is given, right? You know the PE ratio, and you can calculate earnings per share for each company, because you can go the balance sheet and look at, you can find the net income and the number of shares, and then you can find earnings per share, and multiplication of this value gives the price of the stock. And we have not only PE ratio, we have different ratios. The PS ratio, PB ratio. PS ratio is the price over sales per share. PB ratio is the price over book value of equity per share. Same logic, you can find the industry average, and the PS ratio will be given. And based on PS ratio or PB ratio or PE ratio, you could calculate the value of the company. So how to obtain these ratios? Historical average of the specific firm or industry average of the specific firm. Yeah, same. There are two sources of getting these values, the PB, PS, or PE ratio. You can get the industrial average, like all tech companies average, or you can just go back the specific firm historical values and take the average of them and use this value. It's straightforward, but the industry just apply these methods to value the companies. So let's solve a quick question. Problem 4. Suppose IBM latest earnings per share is 12.08, and you want to use the industrial average PE ratio, which is 12.05. So just calculate the IBM current ratio. How can we calculate that? It's already given the industrial average PE ratio. Just this is the industrial average PE ratio here, right? And you know the EPS. What is the EPS? Earnings per share. It's already given. But even if it's not given, you can find it from the income statement for the net income for the calculation earnings per share. Anyway, you know the earnings per share 12.08, and you just multiply the earnings per share for a specific company with the industrial average PE ratio, and you will find 145.56 for the company. It gives you an intuition or a benchmark or some signal. The company price should have around this value, because this is average, right? It's not that specifically gives this is exactly the IBM price, but it gives you some direction, some signal. Okay, problem 5. Suppose IBM latest sales per share is reported as $78.38, and historical average of its price sales ratio is 1.83. What is the estimated price for IBM? Same, we have the PS, we have the sales per share, so we calculate 143.42. Okay, the last question. Suppose IBM's latest book value per share is reported as 19.76, and historical average of its price book ratio is 7.77. What is the estimated price? So we have the values for PB and the book value per share. So we find 157.53. Okay, we've finished all 2 chapters for this week. Let's jump to the exam questions that you solved yesterday. I suppose the questions are simple because, as you remember, there was no calculation. It's just logic questions and 25 questions, and I think it's very straightforward. Let's solve quickly the questions. If the inventory is sold on credit, the quick ratio declines. Is it correct? Is it true or false? If you recall the quick ratio, in quick ratio we have a numerator part, we have current assets minus inventory, the difference between current assets and inventory, and the denominator we have current liabilities. If the inventory is sold, which means inventory is decreased, a decrease of the inventory which causes increase the numerator of the quick ratio. So this statement is false. And the second question, the valuation of stock depends on past dividends. No, we are looking at future dividends. It's false. 3, an increase in a current asset or long-term liability produces a cash inflow. So as you recall from chapter, I guess, 2 or 1, we look at the cash inflows or cash outflows. And cash inflow is increase the cash amount in balance sheet. So what if a current asset or long-term liability, so an increase in current asset. Increase in current asset means maybe the company buys some machine or inventory, so the company pays cash, or maybe using debt. So it doesn't reduce so it reduces the cash, and it doesn't produce cash inflow, it produces cash outflow. So it's false. And question 4, the higher the times interest earned, the safer should be interest payments. It's true. If you remember, more assured should be, okay, the safer, in other words, more assured should be interest payments. The higher times interest earned. Yeah, so it's getting riskier and riskier, and you want much more safe, or you want more assured for interest payments. Yes, this statement is true. Question 5, the return on investment in stock depends on both dividends and capital gains. Yes. Just interrupt me if you have questions, doubts, or whatever, and I try to explain it. But it seems to be very straightforward, but let's see. So question 6, sources of risk include fluctuations in stock price, correct? Inflation, correct? Possibility of bankruptcy of the company, correct? So all 3 is correct. Question 7, if a stock price is 90 and the stock is split 3-for-1, the price becomes, so just divide 3, so you get 30. The answer is 30. Question 8, when risk analysis is introduced into the dividend growth model, the required rate of return considers the growth rate, dividend, beta coefficient, and past dividends. As you may remember, we look at the, maybe I can go quickly to back. No, I would close it. Okay. Let me open chapter 11 and chapter 10 again. I think it was chapter 11, right? We in calculation. Okay, let me see. I'm just trying to find the calculation of, let's see, chapter 11, right? Yeah, it was chapter 11. You may recall the return equity calculation used beta. If you don't remember, yes, I find it. Let me show you this slide. Okay, as you recall this slide, you see the return rate of return uses beta. You see. Okay, let's go back to question. So the correct answer is C for question 8. Question 9, performance is measured by liquidity ratio, leverage ratio, profit ratio, turnover ratio. Yeah, the profit ratio is the performance indicator for the company because it takes into account net income. So yeah, it's used the performance measure. Question 10, according to dividend growth model, the value of a stock does not depend on, let's see, it depends on future dividends, it's correct. Future growth rate, yes. Investors require rate of return, yes, but it doesn't depend on past dividends, right? We only use future dividends. So the correct answer is B. Okay, let's continue. Question 11, to measure risk, the capital asset pricing model uses beta, an asset's standard deviation, the volatility of an asset's cash flow, the term during which the asset is held. Okay, the capital asset pricing model uses beta, and let me find capital asset pricing model for you if I can. I don't know if I can find it right now, but I should. Let's see. I'm just looking at maybe 10. In capital asset pricing model, we are using the difference between market return and risk-free rate, and also beta, right? Yeah. So to measure risk, the capital asset pricing model uses beta. As you see, we're using beta. Okay, anyway, let's jump to question 12. Leverage ratio measures. Okay, what is the leverage ratio? The leverage ratio, if you go to the table that I prepared for you, you can see, you can find the leverage ratio, and okay, okay, the leverage ratio measures the extent to which the firm uses debt financing, the speed with which the firm sells inventory, C, sales relative to some base such as equity, capacity of the firm to meet current obligations. No. So the leverage ratio basically measures the firm, measures the debt financing, right? So because it's basically the debt to equity, like total debt, total equity, and it shows the how the company finance its the ratio of the debt and equity, and yeah, the A seems pretty correct. Definitely B is wrong. C is definitely wrong, and D, capacity of the firm to meet current obligations. It's current ratio, right? It's not the leverage ratio. So it's the answer is straightforward, and the answer to correct answer is A. Let's go to 13. A beta coefficient is a measure of the volatility of A, a firm's position in its industry, B, a stock's return relative to market return. Same, you see the slide. So the beta coefficient is a measure of volatility of what? Volatility of stock return relative to market return. Yeah, the correct answer is B. It's not C, aggregate market stock prices, no. A firm's earnings, no. Let's go to question 14. Let's make it bigger. Okay, 14. Okay, if a firm collects its accounts receivable, what does it mean? The current ratio increases, no. Inventory turnover increases, no. The average collection period, in other words, days sales outstanding, is reduced, correct. The correct answer is C. The inventory is reduced, no. Question 15, a high current ratio suggests that, what is current ratio? If you listen to this a review session by looking at the selected ratio and definitions tables and define the current ratio, and as you see, current ratio is the current assets over current liabilities. So a high current ratio suggests that the firm has a small amount of long-term debt. No. If has a small amount of long-term debt. If it has small amount of long-term debt, but we don't know the short-term debt, right? So put a question mark for answer A. B is the firm is carrying little inventory. The current ratio doesn't relates to inventory. It relates to current assets and current liabilities. Go to C, is able to meet its current obligations. So yeah, the main purpose of measuring the current ratio is exactly this: whether the company meets its current obligations by looking at current assets and current liabilities. So definitely the answer is C. And is profitable? No, the D is wrong. The correct answer for the question 15 is C. Okay, 16, the value of a stock should decline if the risk-free rate declines, the value of stock should decline. How can we measure the stock value? As you remember in this calculation, let's see, I can put this here and you can easily see what I mean. Like, make it bigger, more, yeah. Okay, so the value of a stock should decline if this risk-free rate declines. What is, as you see, the value of stock is equals the dividend growth rate over the required rate of return minus growth rate. So if the risk-free rate declines, what is the effect of this calculation? We use risk-free rate in required rate of return calculation, and required rate of return calculation in the RE calculation we use risk-free rate. It says if the risk-free rate declines, the value of stock should decline. No, because we have smaller, lower required return, and it's in the denominator. It affects, if it is getting lower, the value is getting higher. So no, A is wrong. B, the return on the market declines. No, it doesn't affect. If the value of stock return, if the value of a stock should decline, if return on market declines. If return on market declines, similar effect. If it declines, right, the required return on equity is getting lower and lower, and the value of the company getting higher. No, B is wrong. So the beta, the firm's beta rises. If the beta rises, you see, we have the beta here. It's getting higher and higher. We have higher required return on equity. So if it is getting higher, we have lower. The value of stock should decline. It's definitely, the answer is C. Let's look at the answer C. D, the earnings multiple rises. Multiple rises should decline. If the multiple rises, okay, when we go to the multiples, if the multiple, this is the multiple. If the multiple rises, stock price should increase, right? Not the value of the stock should decline. It's just opposite. Okay, 17. Okay, question 17. Okay, okay. According to the dividend growth model, the value of a common stock depends on what? The dividend growth model. So let's go to dividend growth model, something like this, right? So price of the stock. No, we don't use the price of stock. We are using dividend. Investors' required rate of return. Yes, we are using required rate of return. The future growth in dividends. Yes, G. So yeah, the answer is C. Question 18, the more rapidly receivables turn over. Okay, let's go back to the selected ratios and definitions table and find the receivables turnover ratio, which is one of the top ratio shown in the table. And the more rapidly receivables turn over, the more rapidly the firm is receiving cash. Yes, that's correct, right? Let's go back. B, the larger are the firm sales, the more rapidly receivables turnover. What is receivables turnover? The receivables turnover is equals to annual sales over account receivables, right? So it says we have the more rapidly receivables turnover. So we have getting higher and higher receivables turnover, meaning we have higher sales, or we shrink the account receivables. So we need to find those effects. What is the causes of these effects by looking at the key answers. So the more rapidly the firm is receiving cash, meaning the firm account receivables getting lower and lower, right? Definitely the answer is A. The more rapidly, yeah. Okay, let's go 19. The retention of earnings instead of paying dividends. The retention of earnings instead of paying dividends may result in greater growth and higher stock prices. The retention of earnings, so that means the company doesn't pay retention of earnings instead of paying dividends. So company doesn't pay any dividend, and the company just keep the earnings in the company in the balance sheet, doesn't deliver any dividends, doesn't pay any dividends. What is the cause of it? May result in greater growth and higher stock prices. It may cause it because maybe company doesn't distribute dividends, and instead of paying dividends, maybe company investing dividends on new projects, new positive NPV projects, and the value of the company can, yeah, it's possible. It's possible. B is advantages for all stockholders. No, because some stockholders, all the stockholders doesn't pay dividends. B is wrong. C is favored by stockholders in lower income tax periods. That's wrong. D leads to lower future dividends. No, the correct answer is A. Question 20. We have only 6 questions to solve. So yeah, the time is 12. Okay. 20, a stock dividend causes the firm's assets to increase. Stock dividend causes the firm's assets to increase. As you may remember, let's go to the slides. You can remember the slide. Where is it? No, the other table. Let's find it. Yeah, I will show it here. If you go to chapter 10 slides, right? Go to chapter 10 and look at this slide, this one. And the next question that we have it here. So if you look at this slide and this chapter, you'll see if the stock dividend, if the company pay dividends in stock, the assets doesn't change, equity doesn't change. It causes liabilities to remain unchanged. So it doesn't increase assets, equities, or decreases assets. The correct answer is C. 21, according to the accountants, assets should be recorded at the sales price, the market value, the lower of market value or cost. Yeah, this is accounting terminology, and the accountants should record assets either lower of the market value or the cost of the asset. The correct answer is C. 22, liabilities equals assets minus equity. You may recall assets equals to equity plus liabilities. So liabilities is assets minus equity. Question 23, owners of long-term debt instruments such as bonds would prefer 1, a debt ratio of 50 to a debt ratio of 30. Okay, let me read again. Owners of long-term debt instruments. I own the long-term debt, meaning maybe I bought government bonds or maybe I bought corporate bonds. I bought it, right? What I prefer, a debt ratio for the company, let's say, if it is the corporate bonds, debt ratio 50% to debt ratio 30%. Debt ratio 50% means the default rate or the default risk of the corporation is higher if the debt ratio is 50. I don't want to do that. I don't want to have that. So I just eliminate 1 for all answer keys. Just A and B just gone. 2, a debt ratio 30 to a debt ratio of 50 exactly. Lower the debt ratio, meaning the minimum default risk the company has. So definitely I choose 2. 3, a times interest earned 3 to times interest earned 5. Why I prefer lower? I prefer high interest, right? Because I'm the owner of the bond. The company pays the interest. Why I should go 3%? I want 4%. So it's definitely 4. The answer key is D. 24. We have 2 questions to complete. 24 question. Question 24. A diversified portfolio reduces unsystematic risk, systematic risk, purchasing power risk, interest rate risk. I want to show you the figure that I showed you before, if I can find it, regarding the risk, right? Regarding the, let me open, because once I saw this, I remembered that figure. The answer is unsystematic risk, right? So I don't remember where I put the figure regarding the systematic and unsystematic risk, but systematic risk is stable. Okay, I couldn't find it right now, but just you may remember it. I show the figure in the slides, and in the systematic risk is just same, whether you have diversified portfolio or undiversified portfolio, but you can reduce your unsystematic risk by having diversified portfolio. So the answer is A. Okay, question 25, last question. Stock repurchases reduce total equity, total assets, corporate taxes, total liabilities. So if the company decided to buy its own stocks, meaning the total equity, reduced because the company just buy its own stocks, and it shrunk the equity. And also they're buying the assets, they're buying the stocks by using cash, and the total assets should be reduced. And definitely the answer is A. So we're done. We solved all the questions. You're welcome to ask me questions regarding the chapters I covered today or previous chapters, and also the exam questions. I hope you well done the exam. And I saw the grades. I think you're doing very well. And please let me know if you have further questions. And thank you for the meeting today. And I hope I will see you in the next meeting. Thanks so much.